amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, president of Fadir Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. With A Steward's View, you can listen to this podcast and others at astewardsview.com. Now here's your host, Aaron Kolkman.
To kick off the first ever Steward's View, a Steward's View, just one, not many, I want to make sure we talk about what this is and what it isn't real quick, and then we can dive right in. The first thing this is not a tips and tricks or how-to, a way to navigate a particular circumstance. So if you're looking for advice online or on the air, you probably will be disappointed, right? If you're looking for a way to think about what you're doing, a way to consider the backdrop, the economics of it, the marketplace involved or places, and the impact to your plans, you're in the right place. So I hate to disappoint up front, but I do want to say, let's get to A Steward's View with that in mind. Okay, so today we're on March 3rd. Happy March, everybody. If we can have some applause. We just finished about to finish here in a few minutes, a chaotic session in U.S. stocks anyway, and we'll kick off with some investment tidbits and back into the economics of it, where I really want to spend a little bit more time today than we normally would. This will be a weekly effort, and one that is aimed at recapping what's gone on the previous week and looking ahead to the week that we're now entering into. So with that, let me just say, what a day. We've had a 2%-ish drop in U.S. equities and major indexes. That's for sure the worst day in 2025 as far as equity prices are concerned. That's a big deal. It's a big deal because of the significance of the U.S. marketplace in the world, and also the amount of market cap that's in the U.S. And so I'm looking at that, and I'm not scratching my head. I'm actually going to where we've been since really the last 2 years, and that's what I want to spend a little bit of time on today. So the last 2 years, when we think about the records that were set in, who knows what the Mag 7 is? I think there are about 10 of us in the room. Everybody talks about the Mag 7, and everybody nods their heads kind of cautiously and goes, oh yeah, the Mag 7. Okay, well, the Mag 7 is specifically, I want to read this out loud so that's clear to everybody, including me, for my small brain that can't get all of this kept in it. You have, let's see here. I'm going to actually read the top 10 companies by market cap in the world, okay? Apple, Microsoft, NVIDIA, Amazon, Alphabet, and I'm specifically going to the 7 first. This is not a perfect order for market cap. Meta, Tesla. Is that 7? Did I get 7 in there? Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, and Tesla. That's 7. Okay. The other 3 I want to mention, in addition to those 7, are Saudi Aramco, Berkshire Hathaway, and TSMC, or Taiwan Semiconductor. Okay. Why am I talking about the Mag 7 in the last 2 years? Because those 7 companies, plus the 3 I just mentioned, today hold 16% of the world's market cap. Okay, so if you think about this for a minute, what happened in the stock market today is what happened to in the U.S. Is what's happening with 24% of the world's market cap. Okay, that's what the U.S. large company equity market represents. Okay, about a quarter. So when we take that a step further and say, well, 10 of the companies are holding 16% of the world's market cap. Okay, that's almost unheard of. What does that remind you of? I've got Chaz Louder here with me in the studio. So Chaz, does that remind you of anything?
Brother,
Maybe the .com boom, something like that, where you had these.
I was hardly aware during that, but yes,
profits.
I remember that.
Mega cap sort of moves going on. However, that was different, wasn't it? It was different because at that time, and I'm backing up further to come to right back to today and what happened. You had the situation where companies that were not profitable were being invested in, right? As though they were these big mega cap companies and they were going to do really well. Okay. And everybody had a great idea and what goes up must never come down. Okay. Well, today we have these companies that are genuinely huge, established, profitable, high margin, growing their margins the last 2 years. That's what happened with this boom. Okay. So it's not like, AI came along and created all these new companies. No. These were existing companies that were tech that got into AI, are still in AI, are going to continue in AI, and they're still going to make money, whether AI is there or not, by the way. So what's the real value add to AI? The real answer, if you ask, I probably put some people out of business saying this, no one knows. It's not measurable yet. Okay, so what is measurable is the margins of the companies we just mentioned, the 7 in particular, because they're tech companies, okay? The tech companies that are into AI. So when we say, well, we've got these growing margins, profit margins in 2023 and 4, what does that mean? Well, that means that their margins went up from 2022 to 3, 23 to 4, and then to now only the outlook for the Mag 7 isn't to have growing margins anymore. So what does that mean? The expectation is that those margins will compress. Not that they'll be unprofitable, not that they won't be valuable, not the .com boom. Okay, I'm just trying to communicate that boom back then to kind of bring it to today where some of the same conversations are happening. That's why I reference it, but to draw a distinction in what we have right now. So what we have right now is a whole lot of unknown. And a whole lot of unknown as to the value of AI that caused kind of 2 waves of a boom, if you will, in the last 2 years. That's my opinion, by the way. One towards the end of each year, 2023 and 2024, that caused record stock index moves, records that we've never seen in the history of the S&P anyway. So now we get to today and the stock market's down 2%. Okay. We had a Trump bump in there also last November, right? We've had all kinds of uncertainty, right? We've had inflation kind of waning, but it might be coming back. Oh, the labor market, a little iffy. Can't really tell yet. Okay. Well, what's the Fed going to do? Nobody really knows. Okay. There went a bunch more analysts just lost their job. So I'm telling you that today we're seeing something very, very normal. It's called a little give back. Right? We can't have a 40% or 45% increase in stock prices in 2 years, no matter what the cause, and not give something back. Okay? So let's go back. I could keep going on that point, but let's go back to today and say, all right, well, what's going on? Well, what's going on is that fundamentals eventually take over when we're talking about market prices, no matter the activity. Okay? So when you have a quarter of the world's stock market adjusting like this, I view that as a good thing. Okay. I view it as a healthy thing to say, well, we're going to have this compression in profits. Probably. Does anyone know for sure? But probably we're going to have this decrease in profitability, right? For these huge companies holding unheard of amounts of market cap in terms of the global supply. So what then? More of the same, more of today? Yeah, probably. What do we do about it? Okay, well, I see a lot of headlines saying go to cash. It's an option. What happens when the market takes back off again and you're still sitting in cash? Have you heard the people say, well, I can predict that? Yeah, well, okay. I haven't personally met anybody lately that says they can predict that, at least not in those terms. But I've seen it in 25 years, and it's something to run from. Let's just say it that way. So what if you can't get back in at the perfect time, and the perfect time would mean that you're catching all of the upside of what's coming, the upside, not the downside, then what would you do, Warren Buffett? So Warren Buffett, you're going to cash right now. So does that mean that you're going all to cash, or might you just be taking some profits? Oh, so you're taking profits where you've had all these gains the last 2 years and you're looking to reinvest. Oh, okay. That makes sense. Well, that wasn't quite how the headline read, but it's a great example, isn't it? Right? And this is somebody that's kind of slow and steady wins the race, right? Took him forever to buy into Apple. I mean, it just didn't make sense to him and he didn't buy it. So I digress. The comment today is welcome normal. Okay, let's have some more normal. I'm not totally bearish, but I am bearish. Why am I bearish? Because of what we just talked about, where we've got these companies that are so big that have moved so much of the market in the last 2 years that have to at some point come off of, you know, whatever planet they're on now and back down to earth. And sure, then get into a normal growth pattern. Okay, so what does that look like? Well, that's what I really want to talk about, and then we can get into some of the tactics of it. Okay, so what I want to talk about first is a little bit of an outlook for this year based on the things I just said. Okay, then I want to talk about how we can adjust things in our portfolios, and at some point in weeks ahead, we'll get to the planning points associated. But you know, I am a certified financial planner, and I hold a master's degree in finance, which is financial analysis, economics, and accounting. So that's the boring part. What I don't want to do is turn this into another planning program, because so many of our listeners are either doing their own planning or working with somebody they're happy with. What we want to do is enhance decision making. Okay, so you'll hear me talk a lot about being wise and deciding well, and that's the mission of a Steward's View. So anybody we have on this program, Chaz, our producer, yours truly, that mission should be borne out over time if you're going to continue to listen. So we really want you to be wise and decide well, no matter who you're working with. If you're self-directed, if you're with a planner you're happy with, or you know, just an investor or something like that, whatever your decision points, we want to make sure to be enhancing those. Okay. So let's talk about 2025. I gave you just a snippet of what happened today. I want to go into what's going on with sectors badly, but I'm not going to. So I'm going to sort of tease myself with that, because what's happening as we see this major decrease in the indexes themselves, particularly the S&P 500, is that we're at the same time as we're seeing, 5 of the 10 companies I just mentioned were down significantly today. Okay, and we just closed a few minutes ago. It's no surprise if they're carrying all that weight in the index that they would bring the index itself down. Okay, but the big but and the silver lining, and what I like to see in this normal pattern that we're in, is this broadening of outperformance or new growth versus the rest of the S&P, or those big cap companies that have driven so much. So all to say, there is sector broadening going on. There's a lot of good stuff underneath of this index move down today that feels really substantial, and it is, but it's all in context. Okay, so let's go to a little bit of this year. I want to catch my breath for a moment. Looking at 2025, this is a different year. Almost nobody that I've talked to or read from has gone into this year saying, oh, it's going to be another 2023, 2024. Okay. That could sell some newspapers, I suppose, but in reality, this is a moderating growth year. Okay. So how do I think about that? Well, when we have the expectation of these mega cap companies shrinking their profits, what does that do to PE, right? And what is PE? We hear this a lot on investing shows, forward PE even. The price that we pay for $1 of earnings in a given company or an index, an area of the market even, okay? So right now, I don't even have the PE. I'll have to get that for next time. Some of my friends would be disappointed. S&P 500 PE right now is running at right about 30 rounded. That was the end of February. Okay. So the forward-looking PE at the same point was about 21. Okay. So historically, That's the 5-year average on forward PE is about 19 or 20, so we're about in line there. The historical PE for the S&P 500 is, I have to go get it. I want to say it's in the upper teens, so I'll leave it there for now. But we're a little high at the present day. That's an indication that stocks could come down. But what does PE mean? PE means how many dollars do I pay for or how much do I pay for a dollar of earnings in whatever I'm investing in? Okay, and we're talking specifically about equities, about stocks. Okay, any part of the world, any area of the market. Okay, so if a quarter of the world's market cap is in the S&P 500, what is the PE of the S&P 500? Well, we just said what it was. All right, why is that important? Well, when we look ahead, we look forward, and today, those two, right? There's a difference. We could talk about that, but we look at current and forward PEs, and we say, okay, I think that with all this market cap tied up in 10 companies and shrinking profits, what's going to happen? We just said shrinking profits. What does that mean? Is that happening because the companies aren't running lean? Because their expenses are too high? No, not really, not usually. These are publicly traded firms. I mean, they know how to manage their business, okay? So by and large, it's not an expense problem, right? Sorry, Elon Musk, hate to disappoint you. The income side, right? When we shrink profits, we're shrinking income, right? Typically with firms this big and this well-established, okay? They know what they're doing. They've done it a long time. They know how to manage. Their income's dropping. Okay. Does that mean they're going out of business? No. It means that their margin's going to shrink. Okay. Well, so what? Well, their earnings, their profits just shrunk, didn't it? So my income went down, my profit shrunk. Now, why my same dollar that I spent to get those earnings as an investor, let's just pick on those 10 that I mentioned, right? Is that going to buy the same amount of earnings that it bought last year?
No,
No, it's not. It's going to buy less. Okay, well, at some point, the investor's going to go, well, gee whiz, this is pretty expensive. Maybe I shouldn't buy any more of this. Maybe I should hold on to what I have. Maybe I should sell it, but I'm not buying. Okay, you see what happened there? Okay, so the PE itself changed. The investor sentiment changed with it, and now we have an adjusting market for that particular stock or stocks. Okay. So that's a big deal. It's not the only metric in town for sure, but it's one that really matters when it comes to how expensive is it for investors right now to go and get invested. Okay. So that's one that, in fact, two I mentioned that I look at a lot, and they're obviously related, right? One is present day, one is looking ahead. So I want to mention that because when we talk about shrinking profits, we're talking about PEs going up, right? And the more PEs go up, the more investors stand back. And so when investors stand back and prices are high, what happens to prices? They go down. Mm-hmm. Do they go down forever? No, of course not. But they adjust. They come back to normal, to reality, to whatever that is. And those average levels I mentioned are super important in that regard. So I'll leave that with our audience.
More of a steward's view in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion. Portfolio aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, F-I-D-E-R-E advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
This year to me is about getting back to normal, right? And actually, if you're a client of my firm is Fidere Advisors in Minneapolis or Minnetonka, Minnesota, and if you're a client there, you would have heard this in the second half of last year that I've been expecting. I mean, even if I'm honest, all of 2024, thinking through it here, I've been expecting a moderating growth pattern. Why? For the reasons we just talked about. Okay. Do I think that the U.S. economy or these particular stocks are going to be unprofitable anytime soon. Nope, sure don't. This is the strongest, healthiest economy in the history of the world. And we forget to think about that, right? Don't we? We get caught up in some of the metrics I just said, but it's very, very huge to me to see this adjusting, because in 2022, we had really a 50-year event. Okay. You go back to 1970. It had been since 1970 that we had stocks and bonds. We haven't talked a lot about the bond market today, and we probably won't get to, but we had stocks and bonds down for 6 straight months from January through June in 2022. Okay, that was a substantial, and if you're looking at just the stock side, when I talk about a substantial bear market, bear market territory is a 20% drop in major indexes.
Is this what they were talking about in the news, like constantly, like, hey, if however many quarters we've been down, that's the indication of all this different stuff in the economy.
Right. So there's the economic picture of GDP and, how many quarters before we're in a recession, right? Which is 2 quarters in a row, right?
Yeah, but then they broke that rule and said, just kidding.
Right. And then there's the, and I think it's 2. I'd have to double check that.
I think it was,
but that's, I'm not part of my recent wheelhouse anyway. And then then there's the actual prices of what we're doing in terms of investing in stocks. Okay. And I'm picking on stocks for a reason. Sure. We'll talk about that reason a little bit more as we go in weeks ahead. Okay. I'll state it now that I went there, and that is that stocks are a leading indicator of economic activity. Okay. Jobs, by the way, you hear about jobs. Okay. That's a lagging indicator. Okay. So if you want to know where the economy is going, which one are you going to look at? You're going to look at stocks. Okay. So economists look at stocks, investors look at stocks, all the firms look at stocks. It's as close as we get to a crystal ball vis-a-vis economic activity in the future, right? So when we talk about a 10% drop in stock prices, we're talking about a correction. When we talk about a 20% drop, we're talking about a bear market. Okay. On average, there's a bear market 1 out of every 5 years. Okay. In 2022, we had a bear market. Stocks were down more than 20%. But here's the deal. Bonds were down too. Bonds are often a safe haven, aren't they, during a economic downturn, particularly where stocks are in a bear market. So that did not happen in 2022. We saw something that, dare I say, it had some similarities to 2008 in that we had both major asset classes down for a long period of time and in a deep way, right? Yeah, it was a big deal. So I think most asset managers either don't want to go back to that and think about it, or they don't want to spook anybody. But what I'm saying about today is that we've already been there recently. So to say, oh, well, we're going to go into another bear market this year, maybe, but that was a significant one for multiple reasons that I haven't even gone into. So I just don't see it. I see this moderating of growth. I see this return to normal in terms of the metrics of what investors are doing, not just PEs, but that's a big one. And then we get into, okay, well, where should I invest? And that's a tactical conversation. It's not one that I'm going to have a lot on this program. Why? Because there are lots of different things that investors can do besides tactical investing, right? Tactical investing is fine. We have to distinguish between investing and trading. Okay. Most tactical investing is just trading. That's what it is, right? It's not long-term.
I feel like there could be some greater definition in a book about that.
Sure. Yeah. Thank you for the shameless plug. So when we get into kind of the way about strategic investing or long-term investing, what I really want to do is set aside trading and sectors and that, except, the update of the day like today. And we say, okay, well, it looks like, 9 of the 11 S&P 500 sectors are outperforming. We have a good broadening of growth there going on. Okay, that's a healthy thing, right? I'm just really looking for health. Okay, that's what I want. I really do not want 7 or 10 companies to dominate what happens for investors' portfolios, right? And that has gone on, hasn't it? As we just said, the last 2 years. So let's move forward. Let's look at this year as a moderating growth year, right? And let's expect some chaos. We have this political firestorm going on, on a, I think it's an hourly basis now. I mean, I lost track of how many crazy headlines have come out of the White House since Inauguration Day, and I don't really have any comments along those lines, except to say there's not a single person that's ever occupied the White House that's influenced stock prices in a complete way. Not one. And so I don't expect a director. I do expect a disruptor. I'll say it that way. Okay. So as far as the strategic answers to these things, what am I doing? I'm looking at this as a welcome opportunity. I'm looking at this as a sale. If I'm not retired yet, if I've got a nest egg I'm building, or it's almost built, I'm going to take advantage of downturns in market prices. We can talk about, because it's strategy, not tactics, not just day trading, how do we go about capturing the opportunity when prices come down like this? So we'll get into that too in future programs. We've got weeks this year. So we got a late start. It's March, but we made sure we were warmed up for you. So as far as this year, expect moderating growth, expect the U.S. to continue to lead, expect us to have plenty of chaos along the way. In terms of other asset classes and areas of the marketplace, I can tell you this. I just finished today and maybe a little bit tomorrow reinvesting all of Fidier's asset base, and the way things are right now is very different. And I will not be one to say the market's different, but I'll be one to say the conditions are different. Right. And so what we do to adjust is important, especially coming off of the last 2 years, the way we talked about it. So if I have time, I'll touch on that. I don't really keep good track of time when we're into the program, but I'll tell you this. Right now, as a matter of outlook for investing in where to go and how to take advantage of moves that like today and those that are ahead, I would not be a fan of a whole lot of foreign investment. Is it because of America First? A little bit. Is it because of GDP? Absolutely. What's going on with the U.S. economy? We're putting out about 27% of the world's market cap. That's amazing. Why is that amazing? We house 4% of the world's population. 2/3 of the working population. I'm sorry, of the 4%, 2/3 of that group, the world's populace, is working or seeking work. Okay, that means that 2.5% of the world is putting out 27% of global GDP, and I might be 1% high on that from last year compared to this year, but it's over a quarter. So that's remarkable. It's great we're putting out that economic factor. The pieces of that pie are 3: consumer spending, government spending, and business spending. So consumer spending is the largest part of that. Surprise, surprise. I don't think it takes a lot of rocket science to know that consumer spending is capped. So what I'm telling you here in this program right now is that even though we're putting out a high percentage of the world's economic output, we're still capped at what we can do because our population is capped. Okay, there's article after article that you can read about those who want the U.S. to produce more babies. Okay, this is why. How do we do that? We have more people to consume stuff. Okay, consumption is capped, production is not. Does that make sense? So I just spoke about economic production. I'm sorry. So economic output is only capped by consumption. That's what I want to say. So as far as the issue that we have right now in growing that GDP share that we have, it's a people problem. We can only consume so much, right? And you could say, well, AI is going to add productivity, and that's true. This is the most innovative country in the history of the world. I mean, the Mag 7 stocks we mentioned are all U.S. companies. They're global firms, but they're based in the U.S. So, but to say, well, we need moderating growth in stocks and in just economic output in general, that's true. We can't create another 1 or 2% or however many percent of the world's population all of a sudden to expand consumption, especially with an America First philosophy, tariffs or no tariffs. Mm-hmm. Okay. So what do? Well, we dial back and we look at it and go, all right, well, I probably want at least a quarter, maybe more of my portfolio in the U.S. Okay, well, it's going to be a lot more. Why? Because historically, for investors, does history still tell us something? History still matters, doesn't it? 100 years backwards, U.S. stocks have generated 10 to 12%. Okay, so if we can make 10 to 12% in U.S. stocks compared to about 8% in foreign stocks, wouldn't you buy the U.S. stocks?
Is this where we go into
Warren?
the America chat?
Yeah, I think so. That's where Warren says never bet against the U.S. economy. And he's right. Okay. So he looked at a whole bunch of things I just said and went, okay, well, which ones am I going to buy? And that's really it.
There you go.
That's all he did. And he got a whole bunch of other people to do it with him.
Well, that's how the market moves.
Okay.
When Warren does his thing.
Right. And he's got one of the top 10. So good for him. But as far as the what to do now, it is dialing back from foreign investment for all the reasons that we talked about. It is being cautious. Interest rates are still relatively high in terms of the last decade. Okay. Not historically in decades, but the last decade. So what do? Well, we might want to be cautious of small companies. Why? Because they're leveraged, right? They have interest costs that big companies don't have typically. So watch out for small companies. Mid companies, if I have a sweet spot right now, it's mid companies, mid-size. But by and large, it's U.S., it's large and mid-sized firms, maybe some small-sized firms. And then you look at other asset classes to enhance what you're doing, right? What are those? Well, bonds are most of the time a direct offset to what's going on with stocks. Cash is another big one, but not a primary allocation, right? The question of do I go to cash or not is a trading question, not an investing question. Okay. So the other thing then, other asset classes, I can tell you what Fidera Advisors does. We hold real estate, commercial, not residential. We hold gold. We hold some hedge positions against substantial stock moves like the ones we had today. Oh goodness, what am I missing? We hold bonds in a variety of forms. We hold some bank loans. They're also quote fixed income, but not bonds in a traditional sense. And then we're going to hold some foreign bonds as well. So foreign equities are not off the table. We do hold some emerging market foreign equities. Those are high growth, high volatility. You hear them called high beta investments that we're looking at. And we'll talk more about how to hold all of those asset classes in future weeks too. But in terms of thinking about what's happening now and adjusting for 2025, I want to mention those points. I want to give us that economic backdrop, and I want to try to bring this plane to a level that most anybody can fly it. Okay, so that's what I wanted to start with on our first episode. I hope that there's some nuggets in there for anybody that's wanting to really better equip themselves. I mean, our mission is going to stay our mission, and that's be wise and decide well. So if we can help you with that at all, please don't hesitate to ask. You can find a scheduler in the footer of our website. That website I'll have to read, FIDERE advice.com, FIDEREadvice.com. There's a schedule meeting time in the footer there. There's also, we'll talk more in future weeks about asset aggregation and how you look at the whole of your portfolio, wherever it's held and whatever it's in, all at once, all the time. And that's at the top of our website in a program called Fusion. And so I would encourage anybody that's trying to make bigger picture decisions, particularly planning decisions, to check out Fusion as well while they're there. So those are some things. I just want to scratch the surface today of some of what we'll unpack in future weeks. So with that, I want to thank you for joining, and I'll say until next time, be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, president of Fidera Advisors. To learn more about Fidera Advisors or speak with Aaron, visit FIDEREadvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website astewardsview.com.